Hey there, community bankers. Welcome back to the Correspondent Podcast from Independent Correspondent Bankers Bank. I'm your host, Madison Kaplinger, Marketing Specialist for ICBB. Interest rate swaps are a loan pricing tool often used by larger institutions to manage their interest rate risk and offer their customers the longer-term fixed-rate loans that they want. But how do they work, and what opportunities do they represent for community banks? We mentioned this tool in the last episode, so I brought our CEO, Derek Hetherington, and our CFO, Eli Barber, back on to discuss swaps more in depth. Please welcome Derek and Eli to the podcast. Hey there, community bankers. I am here with our President and CEO, Derek Hetherington, and our CFO, Eli Barber. How are you guys doing today?
Doing great.
Doing great, Madison.
Awesome. So we're here today to talk about interest rate swaps and how they function in the context of banking. Can you guys tell us a little bit about that?
Yeah, I'll jump in. In the simplest terms, swaps from the standpoint of a community banker gives you the ability to price a fixed rate loan to your borrower. In many cases, up to 10 years if that's the term that fits. But pricing a longer term fixed rate loan than maybe you'd normally be comfortable with while maintaining the benefit of having a floating rate loan on your books for your interest rate risk purposes.
Just to add, I think one of the things on swaps from the perspective from a bank, this recent rate environment is a perfect example why a swap can be beneficial. Typically if you're in a variable rate interest loan, if rates moved as fast as they did, your earning assets would move according to the market. And also on the payment side of it too, if you have a borrower and it's a fully amortizing deal and you don't want them to be exposed to future interest rate shock that would impact their debt service, giving them a fixed rate provides them a more stabilized payment over the life of the loan. By using a swap, you can give them a longer fixed rate. And then on the backside, you're also eliminating interest rate risk because your rate's going to float with the market. So it can be beneficial both for you and your borrower, but it is a product that needs to be kind of used in specific instances when your borrower would benefit from it. And it's not really a great tool for everybody. But there are some specific borrowers that if you identify, it could be very beneficial too.
Yeah, I think that's helpful to keep in mind. Swaps sound like a great tool to manage interest rate risk, but what kind of situations or what kind of borrowers might benefit from swaps, and what do lenders need to keep in mind when using them to manage their interest rate risk?
Well, I think first off, you have to have a sophisticated borrower. I think that if you have somebody who's got a clear idea of uh, what they're borrowing for, what their repayment source is going to be, what their kind of pro forma their budget is to repay the debt, and they're not just looking to leverage today and pay it off as soon as they can. Um, you can tend to have a clear idea of who it is that's kind of setting it up. Like they want this capital for this specific purpose. They're going to utilize it over this period of time. Here's a repayment structure that they're looking at, and it's part of that. To support the business operations. I think that's kind of the key. Is you got to find somebody that's got a clear indication what they're trying to do with that credit and with that capital. Because once you identify that, then really it's just more of a tool. Do they want to have flexibility and ability to pay off their debt early without any penalty? And if that's a feature that they want in whatever borrowing that they look at, then a swap's probably not going to be the best option for them because there is a break funding if they were to break that contract on the swap prior to the maturity date. So you can't structure it as a non-prepayment tool. But if they're clearly like, hey, we want this debt, we're going to be using this for a 5-year investment on equipment that's going to be utilized for a specific job, or they're buying a facility to expand their business, or a bank is injecting capital, and they have a 5-year performer plan on how they're going to repay that over a certain time frame, and they don't have any need to repay it or desire to. That's kind of like the key first indication that borrower may benefit from this type of product.
Right. So would you say it makes more sense for a commercial borrower than, say, like a consumer loan product?
Yeah, I think for a swap contract, you're definitely going to want to limit this to commercial deals, um, and and with those probably um, only only loans that are going to be in excess of $1 million, probably as a de minimis is what's going to make sense to consider a swap for pricing.
And kind of just really kind of focus in too, like when you talk about a commercial kind of deal, I think what you're need to look at is really the sophistication of the borrower, which is going to, for consumers, you're going to have a lot of consumer things. So I don't really see this as a consumer product. This is really more for business. It is for, now you could have, maybe like a professional, like a dentist or a veterinarian or somebody like that that has a practice that they're wanting to purchase, or they're investing in a facility or something like that. So it can be for individuals but for a business purpose, and it can be structured in a way that it makes sense for them, given the purpose of it. So, and like Eli said, the for smaller business and consumer type stuff, this is not beneficial. This is more for your commercial products, especially things that are tied to CRE or anything that tends to have a longer amortization period, and the borrower is looking for a longer fixed rate in order to protect their payment as well. And that tends to be kind of the ones that are going to have more interest in this type of rate structure.
Yeah, that makes sense. So you guys alluded to swaps and, being willing to give some guidance to our banks on swaps at the end of last episode, the market update. So what steps, or what are the key steps involved for a community bank to start offering swaps to their commercial lending clients?
Um, well, a couple of things that you need to have in place before you're going to go down the road. One, you need to um, be informed. I think we got a lot of lenders that I've talked to, from different banks that we deal with. I know there's a lot of interest in swaps. And I think recent moves in the interest rate environment, the rapid move up that we saw, I think a lot of people got their minds around, hey, this wouldn't have been so bad if we'd have swapped some of these long-term loans. And today, um, thinking about pricing loans, especially if you're in a competitive deal with an inverted yield curve that we've been dealing with for the past year and a half, interest rate swaps offer you the ability to offer a lower fixed rate for 2, 3, 5, 7, 10 years than what you're probably offering to your customers now, and including what some of your local competition is doing. And as more and more of us are going head to head on our larger deals, our more attractive deals with our sophisticated borrowers, we're going head to head against larger banks that have moved in from out of state, acquired some of our former competitor banks, and they're pricing their loans off swaps. So we're seeing our market change in a way that interest rates are coming at us for terms and structures that don't make sense for loans that we're going to portfolio on our books. So I think, so the first thing that we need to do to answer your question is get people informed. If you're going to go down this path, people in your bank, the lenders, the credit team, because this makes a difference for underwriting, and your accounting people, everybody needs to go into this with their eyes open to know, what's a swap, how does it work, what are the risks, what are the rewards, what are the benefits, which are many, before you enter in to the before you are prepared to entertain and engage in your first contract. So what I would say is that I'm happy to be of help to anybody that wants to have that conversation, wants to get a little more info. We've got some tools that we've developed. I can show you some of the forms. We use Raymond James as our counterparty on our swap contracts that we do. And I'm happy to make that connection if and when that time comes. You want to enter into that conversation. And this is not a pitch from us. That we don't have any sort of referral relationship with Raymond James, so I'm happy to give you any information that I have, regardless of who you choose to do business with. But you know, get informed, call me if I can help, and figure out who you would like to use as a counterparty. Those are really the things that you need to do to prepare yourself to go down the path.
Yeah, and one thing I would also advise too is like I think each one of our banks kind of operate in different markets. So when you're looking at, what kind of tools you want in the toolbox, I think you need to kind of know what your competition is doing in your market, what the opportunity is. So assessing that demand that you may kind of have, if you've got large regional banks in your market, Truist, Chase Bank, US Bank, those institutions, when they do a commercial deal, they're going to have it priced off a swap 90% of the time. They don't want interest rate risk, So a lot of times when you hear like competition's doing long-term low fixed rates in your market, and you don't understand how it is that they can price loans that way, I would almost be willing to bet that they're doing some kind of swap agreement to basically get that, because they're not going to take that long-term interest rate risk themselves. So once you assess that there is lost opportunity in your market due to competition or demand from your potential borrowers, your potential clients and customers, and like Eli said, developing that expertise, making sure you got staff that understands what's going on, how the derivative market works. They're going to be the ones that are going to kind of take the lead for your institution and kind of like, learning it, communicating it. And because you're going to have to establish all the policies around it, you're going to have to make sure that you have those experts, like we use Raymond James as a third party. We're more than happy to partner and I don't want to call us an expert, but, we can help definitely advise and guide, our bank partners. And of course, there's going to be some regulatory compliance. You need to make sure that you're prepared to be able to provide the reports and reserve against these, derivatives and know how that's going to work with your regulator. So, the process is not difficult, but it is something where it will take some time to kind of get your arms around it. That's why we feel like it's good to communicate it out, to kind of say like, listen, you may not need it today, and you may not have customers beating down your door for it. But if you've in the past had lost out on deals that you really would have liked to had in your market because your customers were given a long-term fixed rate option from a competitor in your market, there's most likely you were competing against a swap. If you have that tool available to you and you know that demand at some point in time may come back, and when that opportunity is missed, it'll be too late to try to put the swap in place at the last minute. Like you almost already have to have your policies established, know the regulatory compliance on it, what kind of partners you're going to have in place, the contracts and agreements. All those pieces need to be in place, so when the opportunity does present itself or the demand does come out, you're ready to utilize the tool. So that's kind of why I feel it's important to have the conversation and start to look at it, exploring. First off, is there a demand in my market, and do I feel like this is something I need to have in order to be able to compete for some of these opportunities I've missed out in the past? And if it is, let's walk down that process. And like Eli said, we're more than happy to help kind of guide you, and let you know what the different options are and directions you can go. Obviously you're going to have some policies and regulations and stuff like that you're going to have to kind of like review and navigate, and make a determination on how comfortable your institution is going to be, and how you're going to establish that internal expertise to be able to handle these.
Yeah, it's like so many other things in banking now. The concept is simple. I mean, I could sit down with anybody that's ever done a loan before and teach them how to price a swap in about 5 minutes. Raymond James sends out indicative pricing every morning at about 8 o'clock. So, we can like, for instance, today, if you wanted to price a loan, if your risk tolerance was you needed SOFR plus 300 basis points, and floating, and you want to price yourself in a 12.5 basis point fee, it's just three numbers you add together. So you could offer a fixed rate to that borrower for 5 years on a 25-year amortization for 682 fixed rate for 5 years. And you get SOFR plus 300 floating plus a fee of about $5,400 per million loaned on that transaction. So you get what you want, SOFR plus 300, limited interest rate risk, that's floating monthly. and your borrower gets 682. And I doubt seriously that there are very many banks out there anywhere in this region right now that are pricing loans that they're going to portfolio at less than 7% fixed for 5 years. The concept is simple. Pricing it is simple, but doing all the things that we have to do as bankers on the back end to make sure we're, in compliance, that, everybody is happy, our accountants are happy, our loan processors are happy, and, everything that goes along with that, that takes time. That's, you gotta paper that up a little bit. So, if you're gonna be interested in pricing loans with interest rate swaps down the line, the time to think about it and work on it is now, to get your ducks in a row.
Yeah, that makes a lot of sense. It's a matter of being proactive toward future opportunities.
Exactly.
And I think one of the things too, when you're looking at your, rolling out swaps, once you kind of navigate all the policies and regulations and you're comfortable with, now you've got the, you have the understanding of how swaps work, how you're going to manage it, how this is going to work, who your partners are going to be, and you're ready to go and you're ready to offer that first, swap, to a customer. I think, there's still going to be a process that you're going to go through. You're going to want to make sure you're identifying the right customers. This isn't going to just be something that your lenders are, tooled with to go out there and offer to everybody that they come across. You need to kind of make sure that the education goes all the way out to your customer facing staff to kind of understand, like, listen, if we start to hear, that our customers are looking for a long-term fixed rate loan, that's when that conversation needs to start having. Now, how could we structure that? What kind of rate would we want? What margin would we be comfortable with? And, swaps are typically tied to SOFR. And I know a lot of community bankers, we like to work off Fed funds and prime. So you got to kind of look at it. SOFR tends to float with the Fed actual. So when you kind of look at the Fed actual paid rate and you look at SOFR historically, since SOFR's been in place, pretty comparable where they're at in the market. They tend to float along and they're very cyclical. Fed moves, SOFR moves with it. So if you look at the margin that the prime rate set as 3% over the high end of the target. So if you're wanting a prime rate, you just need to look at pricing your swaps at SOFR plus 300, and you're going to be at a prime rate and tend to be floating fairly closely, if not right at it. So it's one of those things where you can get a good understanding of how to use it, where you don't really have to deviate from how you would normally do things. The only thing that's going to really change is it's going to make it to where you're not having to take interest rate risk in addition to credit risk. We take interest rate risk in our equities portfolio, and we tend to not want credit risk in our equities portfolio because we're taking market risk. If the market moves on it, changes the impacts to the value of our portfolio, and we have to write it, change it to the market pricing at that point. On the loans, we're taking credit risk. So we're already taking a risk of being repaid. So with the swap, it's one of those things where instead of having to now also take interest rate risk, where we're taking an asset as collateral and the hopes that we're going to be repaid on cash, and then now all of a sudden that earning asset is not repricing at the same pace as our liability. So we're actually getting a smaller margin on an asset that has risk. And it's like, so swaps can be a tool where you can kind of start to say, like, all right, if there is a portion of our credit portfolio, or that there's borrowers that we have that we feel like this would work with, you can still get the same kind of pricing you would like to see if you were to just price it as a variable rate price off prime. And you can price it that way through a swap and then give your customer a fixed rate option on the back end. And depending on where the market's at, it could be, like Eli said, it could be a variable rate for you that's going to create a greater yield today than what the market would say that your borrower is looking for in a fixed rate. Or if the rates are really low, it could be a situation where you're giving your borrower a longer, low fixed rate, but protecting yourself that if rates start to trend up and go up like they did here in the last, year and a half, that you're going to float with it, and your asset's going to move at the same rate as the market, and your borrower is going to stay at that low fixed rate. So it definitely is a tool, but there's going to have to be a lot of education on how do you want to deploy it as well. So. And that's, something that we'd be more than happy to kind of just talk through. And it may not be for everybody, but if you do have borrowers in your market that you identify that this would be a great tool to use, I would definitely have the conversation. I would definitely start to look at it as, another resource for you. And when you're out there trying to compete, because we know as the larger banks kind of tend to go out and try to cherry pick the best deals in our markets, they're going to come in with the lowest pricing they can get. And they're going to try to get it as long as they can because they know they're competing against a community bank that's not going to be in a position, if they don't have a swap or derivative in place, to really compete with them when they're using these kind of tools. So if we have that, it gives us that competitive edge, and it allows us to be able to look at how do we kind of maintain these improved margins in a rising rate environment and compete with the larger regional banks who are trying to cherry pick our customers. So I definitely think it's a great tool to have, and it may not be used a lot, but when it does get used, I guarantee you it's going to be very beneficial for you and your borrower, and you're probably going to be pretty happy you got it available.
Yeah, for sure. And you both touched on this a little bit throughout your comments, but how do the current market conditions impact how effective swaps are going to be, and how can community banks stay up to date on some of these changes?
Um, yeah, so one of the reasons that we thought it was a good opportunity to put this podcast out now is because of the inverted yield curve. So, and one way to think about that as it relates to swaps is that the swap curve, the swap market, has already priced in an assumption that rates are going to go down. So, looking out over a 5-year horizon, the swap market has already assumed that interest rates are going to go down, and during that period, they're going to average a lower rate than what rates are today, on the short end of the curve. So, anytime you're in that scenario where there's an anticipation of a lower rate, you can go out and start pricing all your fixed rate loans that are on your books at 6.75% right now. But then you're the one that's taking the risk that rates are actually going to go down and they're not going to go up. Whereas, with a swap, you're putting that risk onto someone else. But the way to monitor that, you can get on a mailing list that goes out. You get on an email list, whoever you choose to be your third party. I get an email every day from Raymond James that lets me know where the swap market is, what the swap curve looks like, so I can see, across all amortizations, across different maturity levels, what pricing looks like, what type of fees we can earn, where the benefits are. And, with the yield curve being as it is today, that 682 price that I quoted a minute ago, I should have noted we're recording this August the 1st at 11 o'clock in the morning. So that was the price at this moment in time. But if you wanted to, the yield curve being the way it is, that pricing is pretty flat. So from 5 years out to 10 years, if you had a borrower that it made sense and they wanted a 10-year fixed rate loan for whatever reason, you can price that at 682, and everything's going to be the same except for the fee that you're going to make is going to be a lot higher if you still priced in a fee for yourself. But so yeah, it's a pretty transparent market. It's pretty easy to stay on top of what the pricing looks like and what the swap curve looks like.
Okay, so all that said, what do you see as the future of swaps in our industry? And how do our banks stay ahead of the curve in adoption?
If you're thinking about swaps in the banking industry, I think that it's been a very widely utilized tool with national and larger regional banks for many, many years, decades. I mean, it's been a very heavily used tool by those institutions for their commercial borrowers. So I think when you look at it from the perspective of the banking industry as a whole, I don't really see it as being new, but I think what's happened is the community banks have been kind of put on alert that the Fed can move rates drastically in a short time frame, and trying to figure out ways from an asset liability management perspective to kind of pull together the duration that we're willing to take an interest rate risk on our assets versus the repricing on our liabilities. It came into hyper focus over the last couple of years, and the interest rate margin compression is still there, and banks are still feeling the pains from having loans that maybe we did at 5 years and 7 years at in the fours back in 2020 21, that now here we are in 24 and cost of funds are sitting in the higher than the return or the interest rate on that 5 year fixed rate that was at a prime plus 50 basis points 5 years ago is now almost 300 or 400 basis points under the prime rate today. So I think that where swaps in the future of banking will happen is I think the banks kind of recognize the risk they were taking, and we kind of gotten lucky that we just hadn't had that kind of dynamic shift that quickly in the rate environment since the 80s. That we kind of got complacent in the idea that, okay, rates can kind of move, but as long as we, kind of are proactive and starting to adjust when we kind of start to see that the rates are moving, we'll be okay. But to have it move that drastically, nobody could have, planned or seen accordingly to be able to adjust that quickly. So I think what ends up happening now is like, okay, maybe banks are going to start looking at maybe they're just not going to compete with fixed rates. Well, if you're going to be out there and you're not going to offer any kind of fixed rate loans, especially if rates get back down and the Fed rates and prime rates get back down into the 4s and 3s, then it's going to be hard to compete if you're not willing to do any kind of fixed rate loan, if everything's going to be variable. So I think in that situation, what's going to happen is banks are going to have to either take risk and start to fix out longer to compete with competition, or they're going to have to find ways to utilize these type of tools. So I do think that it's definitely something that I think it was definitely something that works in the banking industry, because it does eliminate a clear risk the banks take in their asset portfolio, especially on the loan side, that really they don't need to. So I feel like it will expand, but I think it's just going to take time. Banks are going to have to get educated on it. They're going to have to understand it better. They're going to have to learn how to communicate it with their staff and their borrowers. They're going to have to make sure that the regulators are comfortable with how they utilize the tool. And once they do one and they see the benefits of it and they see how it works and they see that they got an understanding of it, I think it'll just kind of snowball and start to gain traction. And I could see it growing over time, but it takes a foundation. You got to start somewhere, and the first part's education and developing a plan and exploring the options. And once you kind of do that and you kind of get there's a demand there, we have enough of an understanding of how this product works. We've got partners that we feel very comfortable about having, and we've kind of navigated how we're going to adjust our policies, make sure that we're meeting the regulations. Now we're ready to offer this as a tool. That first deal comes across, it's going to be nerve-wracking, trying to work through it, communicate it to your customer correctly to make sure they understand it, working with your partners to get that first contract deal done, putting it on the books, working with your loan operations team to make sure it's booked correctly so that you can kind of, make sure that you're processing your interest correctly. It's going to be kind of nerve-wracking. So then once that first one's booked, you get through the first few payments, things are going, then, a year down the road, you'll hopefully have identified that really nothing else was different. It was just that there's some additional paperwork, there's some additional education on the front end, more conversation, more people, maybe another third party involved that normally wouldn't be on a loan closing. But at the end of the day, when it closes, it's still a loan, it still has an amortization, you're still earning interest. It's no different than what you would do on other deals. Just has a couple other layers attached to it.
Yeah, and just to chime in, understanding the value as a way to mitigate interest rate risk, I think bankers are more attuned to that today than they have been at any point in the last 20 years. But I think the other side of that coin is understanding how the value of having that tool, the swap tool in your tool belt, is going to become more and more valuable just because of the competition that's moved in, all across the state of Kentucky, and I know surrounding states as well, where, you probably were pricing loans against, 2, 3, 4 competitors that were in your local market or in a surrounding market. And, you thought about things the same way, your risk tolerances were similar, and everything made sense. And now, we've got a lot of banks that have moved in, acquired banks that, used to be our competition. And, they're approaching things differently, especially if you've got a publicly traded financial institution that's branched in or acquired into your market. They're pricing 50%, if not all their deals on interest rate swaps if they're offering fixed rates. So I think it's going to become more and more attractive to have the swap tool in your belt or have that bullet in your gun, whichever analogy you want to use, as you're dealing with more and more sophisticated competition for loans. And like Derek said earlier, it's going to be your best borrowers, the strongest borrowers, the ones that fit in the box of what that regional competitor wants to get. Those are the loans you want to keep. That's, you probably think of those customers in your head right now. You probably know their names immediately that, you've built your franchise on. And those are the ones that you're going to be most at risk of losing due to hyper competitive pricing that you're not willing to offer if you're taking that portfolio risk. So that's why we're out. Our goal is to protect and preserve the community banking model, and this is a way that we feel like we can. This is a tool that will help do that. So I'm just spreading the word.
And you know what happens, Eli, in those situations too. I mean, if you've got that good of a customer and maybe they've been a customer for yours for a while, and all of a sudden they come in and they say, "Hey, bank down the street just offered me a 10-year fixed rate at 6.75%," and you're scratching your head going like, "How in the world are they doing that?" The competitive nature that we have, there's times where you'll be like, "All right, well, maybe we just see if we can negotiate at 6.99," and you end up like putting yourself in a box where you're basically willing to take the interest rate risk and even take a try to forecast the market and say, well, if rates go down, we'll be okay. And banks sometimes tend to go out there and stretch themselves on interest rate risk and take some margin compression on those customers. Or with the swap, you could actually probably get a higher rate variable today in today's market than what you would offer to your customer. And they were going to be perfectly happy because they're going to get the rate they're hoping to get. And you're going to be actually getting higher yield in today's market than what you probably would price their loan at because they're such a prime customer. You're probably going to cut your rate anyway off of prime when you initially go out there and bid it. So, it's one of those things where even in, with those great customers that you want to kind of take care of and they come in, instead of saying, okay, well, this is a great loan, good LTV, been with us a long time. I feel confident we can kind of maybe take prime minus a half. Well, now all of a sudden you're taking a below prime rate today. You're taking that interest rate risk on yourself, or with the SOFR product and swaps, you're pricing them under that rate even, and you're still going to be getting a prime rate. So it's one of those things where it's like, if you look at it right and you take the right approach, you're going to be better off, and your customers going to get exactly what they want. Now, it doesn't always work out that way. If you talk to your customer and they don't feel comfortable not being able to repay because they may want to sell this property in the next 3 years once it stabilizes on a new project or something like that, then it's not the right product. And you don't want to give them something that then 3-4 years down the road could be detrimental to their business plan. So that's where that's kind of important to make sure that you use it right. Where some of the larger regional banks, they're probably going to be more like, hey, listen, you're going to have a prepayment penalty if you want to pay this off early, but we're going to give you this great rate. And sometimes that communication with the borrower isn't. They don't condition them to be prepared for when they want to do a modification or a change or sell that loan and divest that loan, and that impact the swap could have on them. So you got to make sure that you communicate correctly. And as community bankers, I think we can do it better and serve our customers even better having this as a tool versus it just being a tool that our customers have available through the larger regional banks.
Absolutely. Well, Derek, Eli, thank you guys so much for joining this episode today. I'll put your contact information in the show notes in case any of our community bankers are interested in learning more about this tool. And I really think that, like you said, Eli, this is a great tool for us to help promote, protect, and support the community banking model.
Yeah, and just finish up. Every banker that I've ever talked to about swaps had half a dozen questions. So I know there's people out there that have questions, and I can answer some of them. I might not be able to answer all of them, but reach out. I'm happy to have. I'm a swap nerd, so I'll talk about swaps until I'm blue in the face. Just did. So call me anytime.
And as a lender, I came up, I've worked for institutions where swaps was one of the first things we looked at. Is like, if we had a new commercial deal come across the table, and we were looking at pricing, one of the first things we looked at was, does this fit the model for a swap? And it was always based because there was a fee on the front end, you had a variable rate. So, and then from a competitive perspective, I always found that, it was pretty amazing how competitive you can be when you can get your pricing thin enough as an out of market player. You could go into a small community and cherry pick good customers with really, really attractive rates away from strong community bank relationships. So now being on the community bank side and kind of knowing how the dark side operates, I'd highly encourage lenders just at least become educated on how swaps work. Because I think sometimes there's a disconnect on how it actually works, and it could benefit them just even to know how it is that their competition is behaving in their markets to try to cherry pick their customers. So I think a conversation, learn about it, talk about it, make it part of your kind of strategic discussion on, is this something that we feel like is going to be valuable for you, for your customers and your communities? Reach out to us. We'd be more than happy to kind of have that conversation with you on how we've kind of gone about it and the approach that we've taken. And we've through that, we've kind of made some connections with some really strong third parties that have helped us kind of navigate the policies, the compliances issues and stuff that we've had to kind of navigate in order for us to be able to make this part of our product offering as well. So love to have a conversation with anybody that has questions. And obviously, like you said, Madison, our entire focus is to, help the community banks, to protect, promote, and serve the community banking industry by preparing them to go out and be able to compete, stay relevant, and service their customers and their communities in the best way they possibly can.
Absolutely. Thank you both again for joining me.
Yeah, thanks for having me.
Yeah, it was great. Thanks, Madison.
Thank you for listening to the Correspondent Podcast from Independent Correspondent Bankers Bank. We hope you've heard something that you can take back to your community bank. Be sure to follow us wherever you get your podcasts. If you're listening on Apple Podcasts, leave us a rating and review, or on Spotify, turn on the notification bell so you never miss an upload. See you next time, community bankers.